was like a deer in headlights last week. But I sent out a new one that has a more, the last problem we're going to do, the last couple of problems we're going to do are a little bit more, they're better. They're more relevant, I think, easier to follow. But anyway, and then we're also going to do the chapter 5. And I think I'm going to hold off on the chapter 5 exam until next class, but we'll do some multiple choice questions and some other things. And so anyway, let's go ahead and pull up. So this is, I got the new chapter 4 handout. Let me share my screen. Here we go. Okay. All right. So I actually changed the, I used your guys' new cost for it. But anyway, so coming down here, it's actually on this last one that where I changed it around a little bit. Nothing wrong with the way it was before, but I don't know. I wanted to make it a little bit different. So anyway, the lower of cost or market. In this case, lower of cost or net realizable value is the new terminology. And this is for both the US GAAP and the international standards. The US standards for what they called lower of cost or market was absolutely crazy. They used to have that. Actually, a few years ago they had it. And they changed it now to the net realizable value. So in that way, calculating the lower of cost or net realizable value is the same for both of them. There's a little bit of a difference in that they, the recovery of the if there is a, here's the problem you have. You have inventory that has a cost, and the cost is such that you can't sell it for that. So for instance, if I had this calculator, maybe it's an old calculator, I'm just making this up, but like, let's say I paid $5 for this calculator, and at the time I thought I could sell it for $8. Well, a few years go by, I got an old calculator, and now I can only sell it for $3. Notice that I paid $5 for it, but I can only sell it for $3. So the idea is I shouldn't have it on the books for $5. I should reduce it down to what I could actually sell it for, which is $3. So that's the whole idea of the lower cost or net realizable value, is how much can we really get out of this thing? And for some things, it can be quite significant. Things like tech stuff. Who wants a 5-year-old whatever? So there seems to have a really short life. So there are some things, there are some industries where this is a really important thing. But anyway, so we're going to see how to do this. How we actually do the lower of cost or net realizable value. It's kind of funny though. I'll tell you this as an aside. Prior to Enron and WorldCom, and then Sarbanes-Oxley, the U.S. standards were pretty much set to take over the world. Many countries were going to U.S. standards before that. The reason being, every country had their own standards. So Germany had their accounting standards. Britain had their accounting standards. Singapore had their accounting standards. Japan had their, every country had their own accounting standards, and that was absolutely common. I mean, for instance, the British standards, they didn't have statement of retained earnings or changes in equity. They included that in the balance sheet. Under the equity section, you'd have a complete list of all these transactions that happened. They only had 2 financial statements. The income statement and the balance sheet, and that was it. And everything, was included in those 2. So anyway, every country had their own standards. After Sarbanes-Oxley hit, and part of the reason why they liked the U.S. standards is they were very consistent. You had to have a really good reason to make a change. You didn't just change, whatever the standard was for, a trivial thing or something that was a current event. You had to have a good reason. I'll give you an example. When they looked at pensions, they took a really long time to figure out how to account for pensions. It literally like over 10 years. And then finally they came out with a pension rule. So they weren't quick to move. They were very stable, very the same standards every year, and you had to have a really good reason to change them. Okay, after Sarbanes-Oxley, the idea was, hey, none of this stuff is working. We got to start making some changes. So not only did they make a lot of changes for auditing, accounting changes all of a sudden came like crazy. I mean, they were making early 2000s. They were making, every year you get 5 significant new changes, and it was you really had to be on your toes to figure it out. It was around those times that they came up with the international standards. Like, look, we don't know what the United States is doing because these are changing like crazy. So actually, we kind of lost, that U.S. is taking over the world with our accounting standards, and now it's become the international standards. But a big part of that was kind of the reaction to Sarbanes-Oxley, and the idea was, instead of saying, gee, we don't make changes unless it's really necessary, it was like, how many changes do we make this year? Oh, we made 15 changes. That was kind of like the thing they were, bragging about, was how many changes we made this year, rather than the way it was before the Sarbanes-Oxley and WorldCom and Enron and all that. So anyway, that's where we got those kind of strange lower of cost or market rules that we had for US GAAP that literally had like 6 or 7 numbers you had to play with to find one number for but anyway, now it's changed back to, now we're going along with the international standards. So this is one of those things that, the simpler international standards won out over what we had. Okay, so lower of cost or net realizable value. So whichever is lower, our cost or what we can sell it for. Okay, so let's take a look here. Typically done on item by item basis. So each item you take a look at, it is allowed to do a grouping. There's no period there. It's allowed to do a grouping if they're related to the same product line, but generally item by item. Write downs are reversed when selling price increases. This is for international standards. And US standard uses the same approach, but without the allowing for reversals. We don't like to have people reversing things. I don't know why, but we don't. So let's see how this all works. And by the way, some of the things I have in here are the things that we would have for the old way that we used to do it. And you might be wondering why I put those in. Whenever there's a change in accounting rule, it's more likely that the CPA will test on it. So the CPA exam will test on newer rules sooner. And they will usually include stuff that maybe isn't relevant to the new rules. And that's what this is going to, see this on here. To see who's using the old rules rather than have learned the new accounting rules. So that's why you're going to see some things on here that are no longer, because that's what you'd probably see them on the CPA exam. Okay, so let's take a look. Here's a net realizable value computation, and I'm going to use this down here as our, plug the numbers in. Let's make those. Okay, so current selling price is $260. Minus additional selling costs, 20. And this will equal our net realizable value, which is 240. So this is our net realizable value, 240. Notice we don't need this replacement cost. What did I do? Here we go. A very thick line. And we don't need the normal profit margin. These are things that we used to use with the old, so we don't need those at all. I don't know, let's. So those are not necessary. So all we need is the current selling price, additional selling cost. Okay, so the net realizable value and historic cost, we want to take the lower of. Okay, so net realizable value is 240. And our historical cost of this what we paid for it was 225. Okay, so which one are we going to take? The net realizable value or historical cost?
Realizable value.
I should take the historical cost. We're going to take the lower of the two. Hold on, let me change it.
Oh, okay.
And here's the idea. Okay, yeah, we paid 225 for it, but we can sell it for 240. So we're not going to say that this is really impaired, right? So we're going to keep it on the books at 225. Now maybe it's not selling for what we wanted to sell it for, but it's still going to sell. We're still going to make some kind of a profit on it, or at least break even on it. You know, in this case, a little bit more than break even. Okay, let's go to the next one. Net realizable value still 240. They tell us the historical cost is 300. So which one's going to be the lower? Of the two?
The net.
Yep. Yeah, and here's the whole idea behind this. Look, we paid 300 for this thing, whatever it was, but we can only sell it for 240. So we're going to write it down. So we will write down this it'll look like this. What is this? This be sort of like a loss. Why don't you gotta write it down? We gotta write it down 60. And then at some place we'll have either take it right out of the inventory or some kind of an account that would be set aside for it. So I just put it in inventory or take it out of inventory. So this would be in the inventory, an asset decreasing by 60. So this would be the journal entry that we'd write for that thing. Yeah, I mean, if this was the only one, obviously. It's possible you put it into a separate account, a contra account. It's possible. Okay, so we have net realizable. So this would write it down. So our cost on the books would be 300, and we now take 60 out of it, so it'd be down to 240, which is what we can sell it for. Yeah. So that's what we'll put on the books. We'll keep it on the books for 240. Okay, now suppose something weird happens and the selling price jumps up to $500. How would this change impact the financial statements? All right, now for international standards, write-downs are reversed when the selling price increases. Okay, so coming down here, what if the selling price jumps to 500? Okay, so you have something that looks like this. So now the net realizable value is is the selling price 500 minus the selling costs $20. 20. So the net realizable value is what, 480? Okay. I'm just going to move this down one. Okay, so the net realizable value now is jumped up to 480. Now, under international standards, we can recover. I'm off the page already. I'm gonna get a little more room here. Okay. So the international standards are that we can recover the write down. Now, we can only recover the write down. We're not going to write it all the way up to 480. So we can only recover the write down. So how much are we going to add back in? So
Is it 20?
Close. Actually, it's going to be, actually, here's what we're going to do. For the international standards, we're going to reverse this out, basically. We're going to write it back up to the 300. Or, whatever it recovers by, but in this case, it recovered more than the, what are they? I should say recover. And if it went back up to whatever, anything that's over 240, if it went up to 250, then it would be recovered $10 or whatever. But in this case, it went all the way through the 300 and all the way up to 500. So we're going to write this back up. So we would simply reverse this. So this would be inventory, which is an asset, and it's going to increase by 60. And we're going to have a recovery sort of like a gain of 60. Oops. Let me see if I can clean that up. So this would be, we put it back on the books. We'd write it back up to, so this would be restored back up to the 300. we get back to that historical cost. We wouldn't write it all the way up to 480, but we would recover whatever we wrote off of it, up to the amount of it recovered. Under GAAP, no entry. You can't recover. Under GAAP, it just sits on the books at 240. So it's still a little different, I guess, but and you'll find that true of GAAP for most things is that we do not like to have things. We don't like recoveries for whatever reason. So there's no recovery. There's no journal entry for it for GAAP. It'll still just sit on the books at 240. Question on that thing? And this is a little bit confusing. You should have seen the wacky one we had before. Yeah, we used all of this stuff in there. Came up with a ceiling and a floor, and where it was in the middle between the ceiling and the floor, and all this. Okay, so let's save that one. And by the way, you're doing this on two different spreadsheets or two different documents. So however you want to, if you want to submit it in two different documents, that's fine. You can have unlimited submittals as far as turning it in. Yeah. Okay. Let's go. Oh no. Sorry. Let's jump into chapter 5. This won't take very long. I'm really serious about, I'm going to hopefully get this, just for you guys' sake, get all the teaching done within 10 weeks. And that way, you don't have to finish the class in 10 weeks, but that way, hopefully it'll get out of the way and that, you can budget your time however you need to for your other classes. Okay. So let's go to chapter 5. And current liabilities. And so we're talking about liabilities. This is kind of, we'll talk about this a little bit. But anyway. Okay, so current liabilities. You guys, this is stuff you guys already know. I expected to settle within one normal operating cycle. This is usually 1 year. Held primarily for the purposes of trading. In other words, that usually these are for operations. Settle within 12 months of the balance sheet date, and no right to defer until 12 months after the balance sheet date. This is kind of like a refinancing thing. Now, here's where it gets a little bit sticky. Refinancing short-term debt. And there's a current trend that is, actually, we're having a little trouble with it now, but what companies were doing is, usually long-term debt, you have to pay a higher interest rate. It's riskier, right? So, if you borrow money for 1 year, risk for the bank is relatively low. You're probably going to be in about the same financial situation, so it's fairly low. So they have a lower interest rate. The longer out you get, the interest rate goes up. So many companies have been doing this for years, and that they take a look at that and they say, okay, well, if we do a short-term financing, we'll pay 2.5% or whatever it is. If we do long-term, and usually you want to match up long-term investments with long-term liabilities. They call it the hedging principle in finance, if you're interested. But they, so usually if you buy, if you're going to do a long-term project, you get long-term financing. That's how you minimize the risk. Well, companies, if we looked at that and said, okay, we'll have to pay 6% if we do long term. If we do short term, we'll just pay 3 or 2.5 or whatever. And even though we need to do this over 10 years, we will just keep refinancing it every year. So, this year's 2.5%, maybe it's 3% the next year, maybe it's 2 point whatever, that the short-term financings will generally have lower interest rates. And even if they do go up a little bit, later on, we will have had this benefit of paying lower interest rates because the short-term are less risky than long-term. 10 years ago, we didn't know what COVID was, right? So the longer things go out, the more risky they are. Now, the problem is a couple of things. First of all, when companies refinance that, the interest rates may go up. It's possible they go up more than they could have borrowed long term. That's kind of what's going on nowadays a little bit. But another problem that companies have is money shortages. They can't, because so many companies are doing this, they can't actually get the financing. And there was a crunch in money in 2008. Harley Davidson was using the short term, and they couldn't get financing anywhere in a very profitable company, and they couldn't get money to pay their payroll. They ended up, some hedge fund or something loaned them money at something, some crazy amount, like 18% or something crazy, percentage, because there simply wasn't money for them. They were doing this, 2-3% a year, thinking, oh, haha, this is great, and then they get walloped with that. So you got these kind of weird things. So there are but this is a common practice now. This is common practice. Finance people will tell you not to do it, but companies do it. It's riskier, and risk and reward. It's riskier, but they think that it's worth the risk is worth it because you pay less interest. Okay. So there's a couple different rules, though, between the international standards and the U.S. standards. For accounting purposes, the international standards say that you have to have, if you're going to refinance it going into the next year, that you need to have that on the books, have the agreement, the written agreement, before year end. So they say, look, before December 31st, unless you want that all showing up as a current liability, you have to have that refinancing on the books, that it's going to be refinanced before the end of the year. U.S. standards are a little bit more lenient. They say before the audit report date, which usually is a few weeks into the next year, that you have to have it. So it is possible that you have a company that didn't do their financing till, say, January 15th. In the two different methods, the international standards will show them having a huge current liability, and the U.S. standards showing them not having, hardly any current liability because of the timing of it. So there is this kind of weird thing, and they have to have their ducks in a row. Basically, the international standards are a little more strict than the U.S. standards. Just a quirk of it. So, the international standards, if it's refinanced prior to the balance sheet date, year end. I gave it to you, a couple years old. And the U.S. GAAP says, okay, well, you have a little bit longer, and until we issue the audit report, you can get that refinanced. Then it's fine to put that as long term on there. So you could have a problem where you'd have the international standards have a different current liability than the U.S. standards. Yeah. Same thing here on the accounts payable on demand. Overdrafts. IFRS says overdrafts are taken out of cash. US says if you overdraft, that's a liability. It's kind of like a payable. So that's probably not too big of a thing. Probably doesn't happen all that often. The things here. Okay, contingent liabilities. Contingent liabilities. Well, first of all, let's talk about what contingent means. If we say it's contingent, what does that mean? For instance, I'll give you something that's contingent. An umbrella. If I go outside and we're trying to decide whether I'll have an umbrella or not, what will have to be present before I take an umbrella?
It would have to be contingent upon it raining.
Exactly. If it's raining, then I'll take the umbrella. If it's not raining, I won't take the umbrella. So it's contingent on something. So when we talk about contingencies, we talk about things that are going to rely on something happening in the future. Often it's lawsuits and law cases and those sorts of things. So it's contingent on something happening in the future. And the question is, how do we account for that? How do you account for it? If you're getting sued or you're suing somebody else, how do you account for these contingencies, things that are relying upon something else? And so that's what we're talking about here with contingent liabilities, often lawsuits. Now, in the United States, the legal aspect of it is much more important because our legal system is, I think we talked about this before. We have huge lawsuits. Other countries generally don't have the same legal system we have. They don't have $10 million payouts for someone falling on a property or something like that. Whereas U.S., they do. So provisions recognized under IFRS. Okay, so there's an obligation from past events. So, there's probably going to be something, either a lawsuit has already been filed or it will be. That there'll be an outflow of resources, usually cash, and that there is a reliable estimate. Okay, constructive obligation arises from past actions or current statements indicating the company will accept responsibilities. This is something that U.S. companies don't do. U.S. companies will say, look, if you put that on the books, then the plaintiff is going to say, hey, look, they know that they were wrong because they put it, even right in their books, they put on there that they are going to owe us, whatever amount of money. So you have this kind of weird thing in the United States that we don't have this idea that, look, this happened in the past and this is, you're going to have to put that on the books. Part of it is because of our legal system. That if you put it on the books, it's as much as admitting to that you owe this money. Okay. And again, these are usually very large amounts, or they can be in U.S. standards. So constructive obligation, past actions. That is not something that we have in the U.S. Okay, so here is kind of how it breaks down. Okay, possible obligation governed by occurrence. So something happens, or maybe you're obligated to make some kind of a thing, or that it doesn't occur. You're obligated to buy a certain amount of products or whatever it is, and you don't do that. Present obligation not recognized because no probable outflow amount cannot be measured reliably. So you don't know if it could be millions, it could be zero. You can't do it. IFRS, more likely than not, 50%. So these are generally things you put in the footnotes. U.S. standards are pretty much the same. However, this is a kind of an odd one. Probably usually means 70%. How we came up with that, I don't know. You know, this one kind of makes more sense and that is more likely to happen. But U.S. and I think probably because in the U.S. The dollar amounts are just so huge. Okay. All right. So here's how this kind of works out. We'll come down here. We'll do a problem that kind of shows it. International standards. If you put this on the books, you're going to put this on the books at the probability weighted expected value. And you'll also discount that in case they are going into the future usually. You know, it's going to have more than a year in the future. Now, they do have that they can omit the disclosure. It can be expected to prejudice seriously the position. So if there is a real problem that it might weaken their case, it is possible for them not to record it. So now this is one of those things that we do think about for the U.S. because that's exactly why we don't allow for past actions to be recognized on the books. But if they say, look, if you know, especially if this is going to be a U.S. case or something like that they're up against, they say we don't want to put it on the books because it'll prejudice our position, it'll hurt our position. It's possible that if they can make that argument, they can admit it. Now, U.S. So international standards, they do the weighted, and they will be discounted if extending you're talking about if it goes into past a year. U.S. the low end of the range of possible amounts. And again, why? Because this is, they don't want to admit to large dollar amounts on their books because someone can point to it and say, look, you're admitting that you owe us all this money because it's on your books. Okay, so let's see a problem here. So we have this range of losses. So this is the range. You know, whatever this is, a lawsuit of some sort. And it arranges that, you know, it could be $1 million. Could be $2 million, could be $5 million. And here's the probabilities. So the probability that the loss is going to be $1 million is 20%. Probability that it'll be $2 million is 50%, and 30% is $5 million. And that's how we came up with this total of 100%, basically. Okay, so we'll weight those averages. We weight them out, and 20% of $1 million is 200,000. 50% of that, you get the idea. 30% of that. So, international standards would show a weighted average of that. U.S. standards would be the low end of the range. So here's the range. So this is how this would be shown on the books. International standards, you take a weighted average. U.S. standards are you take the low end of the range. And by the way, if the low end is down to 0, that means you don't recognize it. You know, if it's possible that you have a 0 in there in the range, you wouldn't recognize it. So anyway, if they're getting sued for $5 million and they only book 1 million, it's not as likely going to hurt their position if they're using the U.S. standards. Question on that? That's all there is for chapter 5. Okay. Any questions? So those, they're little needly things. They're not huge differences. Usually the liability thing's a little bit different. But if you think about U.S. standards, low range, international standards, weighted average. And the weighted average is probably a better estimate of it, but because of U.S. law, you don't want to do that. You don't want to admit that you owe this money that maybe you would otherwise not owe if you didn't book it on your books at say 2.7 million. I think I told you. I don't know if I told you this or not, but the international standards versus U.S. standards. Up until this year, basically, they used to test. Used to contrast it. What's the difference between the international standards and what would the difference be, and that sort of thing. They generally don't do that. Now, their new thing is they might test you on the international standards. They might test you on the U.S. standards. They don't talk about what's the difference between them. So they may say, okay, here's this case. What would the liability be under the international standards? They wouldn't even ask you what the U.S. standards were. They're not going to tell you to compare them. They're just going to say, but you need to know how to calculate those international standards. Or they might say, what would be the contingent liability under U.S. standards? Those are the kind of things that they generally won't do the compare and contrast anymore. Okay, so that's it for chapter 5. Let me save this. And you guys got that the first exam, right?
Yeah.
Yes, I got it.
Yeah, it's not hard. And this one, next week we'll go over. We'll do some multiple choice questions because some of this stuff is kind of wordy. So we'll do some multiple choice questions. You guys get extra credit points for that, and then I'll send out the test for this next week. But so let's see. The chapter 1, 2, and 3 handouts done. 4's done. 5's done. So we can turn. So those. Do I have those set up? Oh, wrong thing. You guys have your own class, by the way. Did you guys know that? Everyone has their own class. I think I set it up. Let me check. Yeah, so 4 and 5 handout. You turn in the test. Can you turn? Okay, yeah, that's all. Okay, so I'll see you guys next week, and next week we'll kind of clean up chapter 4 and 5 and go into chapter 6.
Okay, see you next week. Thank you.
See you guys. Have a good day.
Sounds good. Thanks. Have a good night.
You too.